Welcome to a fresh edition of the 76 Report. I am Trish Regan. I am here and thrilled to be here as always with my wonderful colleague, esteemed colleague, longtime Wall Street investor extraordinaire, managed billions of dollars on Wall Street for many, many years, Rob Hordon. Rob, good to see you tonight.
Yep, great to see you tonight as well.
So we got a lot going on in the news flow right now. I want to zero in on a particular report that has caused some concern, some alarm, and that's that the Labor Department somehow miscalculated the number of jobs that were added to the economy in the last year to the tune of 818,000. Now, I realize, non-farm payrolls, they don't always get this thing right, but the concern here is, what does it mean for markets? Could it actually be good news for markets? What does the Federal Reserve meeting in Jackson Hole, Wyoming do with this information at this point in time? Your take.
Yeah, so it's been a pretty turbulent August so far. And it's funny, I was just looking at the chart. You go back 2 weeks ago, the market was basically bottoming out and traded off about 10%. And this was in the wake of a weak jobs report. If you recall, it was just about 2 weeks ago. And then we had that development with the yen carry trade, which kind of accentuated the selling pressure. But now here we are with the S&P basically almost back to its mid-July highs. And it's on the heels of this revised downward jobs report, non-farm payrolls, which suggests labor market weakness, which might be a little bit confusing since it was labor market weakness that sent the markets down in the first place.
Right. It's like Alice in Wonderland, like what's down is up and up is down, and it's through the looking glass, so to speak.
Yeah, absolutely. But I think the narrative now is we're the market's interpreting this as the foundation for rate cuts, and It's getting excited about rate cuts, looking for clues tomorrow at Jackson Hole for what Powell might have to say that would sort of indicate that. So the market is getting excited. Gold is reflecting lately this week, breaking through 2,500 and sort of pressing all-time highs, reflecting this idea that we're still kind of in an inflationary environment, but due to the declining employment picture, we're headed into a rate cutting environment, which is very favorable for gold and other inflation sensitive assets and stocks generally.
I want to dive in a little bit deeper. We are getting quite a tune in here to the live broadcast. Some of our favorite folks here. Michael, good to see you. He wants to just shout out hello to both of us. And of course to our good friend Don Baca, who's always working hard to help build certainly the Trish Regan channel and as well the 76 channel. So thank you for that. And cheers to you in Prague. It's got to be quite late there, Don. Let me ask you though, okay, so you've got this scenario where the economy may have faltered more than anticipated. I mean, I think to a certain extent, investors have baked part of that in. And what's bizarre about all of this is that actually it could lend a helping hand, if you would, to markets. Now, we may be just postponing the inevitable, right? Because the fear, of course, is that you're going to drive more inflation. I, for one, and we can talk a little bit about crypto and gold, I, for one, think the Federal Reserve tends to get these things really, really wrong. But there's a problem sort of fundamentally in that I think the Fed and other policymakers are not necessarily looking at the most accurate data, the most fresh data, the most sort of in touch with the American people and the American economy data. And that causes this lag effect, whether they're behind the curve or ahead of the curve on interest rates. They tend to get it repeatedly wrong, which is why Milton Friedman said, replace them all with a computer.
Yeah, it's actually very disappointing. I mean, I think on the one hand, there's this concern that there was like a deliberate attempt to sort of produce a rosier picture of the economy and of employment over the past year, and certainly President Trump has indicated his point of view on that. But I mean, if you think about other problems with this massive revision, because it's not just the 800,000, I believe there were about 400,000 sort of cumulatively adjusted downward up to this point. So in total, it was like 1.2 million. And the question is, how could they get it so wrong? And it's just such an important data point. And if you think about the private sector and, retailers like Costco or Walmart, like they have real-time information, very granular about what's going on in their stores and their business. And yet our federal government is making these like kind of assumptions about business formation and closure that are like static and don't reflect changes in the economy. And it's disconcerting that, we don't even have like a good model or a good read with all this big data out there and all of the sort of unlimited resources of the federal government. They're still making such poor forecasts.
Which is why I suppose when we say it's sort of some of these assumptions get kind of baked in, if anything, this is perhaps a positive for markets because investors are like, woohoo, we're going to get a rate cut, perhaps more than we anticipated or sooner than we anticipated or more of them than we anticipated. But you're right. And in fact, maybe that's the real problem, the real scandal, if you would here, the fact that with all the technological capabilities that we have, somehow, and by the way, I think markets tend to get it right more often than the Fed, but somehow the federal government doesn't have access to the best, most sort of vibrant and accurate data. I mean, that's alarming.
It is. And this was the second biggest revision since 2009. And what happened in 2009 is you had that rapid deterioration in the economy. And again, at that point, the BLS missed it, right? They didn't adjust their models, and that was why you had the even larger revision. So it's a little bit also, kind of concerning that, if you think back to 2009 and there were real underlying, deterioration, there was real underlying deterioration in the economy. Is that taking place right now? This economy a lot less healthy than people have thought it to be. And that's what's really driving this idea that we're going to get 3 or 4 rate cuts this year, as much as a percent. But all the while, inflation's still clocking in north of target levels.
Indeed. I mean, they'll say, hey, down to 2.9%. But look, if you're looking for 2% and you're at 2.9%, I don't necessarily consider that a victory. Not to mention it's cumulative in and of itself, and consequently the American people are really struggling. The other factor in all of this, and one of the things that I think was a tip-off for me, was that you didn't see wages going up appreciably, right? You did not see wages going up at the same rate as inflation, which I think is a little bit of a warning sign, because theoretically, you should see this kind of wage growth happening simultaneously. And while you've seen some, it's not as extraordinary as, say, the inflation that we've seen, with eggs up 57%, car insurance up 54%, electricity up 23%, for goodness sakes.
And Trish, this is why inflation is such a nasty problem, because when you think about what is the point of interest rate hikes and restrictive monetary policy, they kind of couch it in language like they talk about JOLTS, the job openings, and these metrics, and that there's too many job openings per worker. But what they're really talking about is, raising the unemployment rate, suppressing wages, right? Hurting the labor market, hurting the wage pressures on inflation. And that's the point of interest rates, to kind of hurt the bargaining power of workers. And they don't like to talk about it, but that's
okay. I know where you're going with this. And by the way, good to see Mike Costa's on here. We have a lot of familiar faces from the Trish Regan show. A little shout out to my other channel. But thank you guys for coming over here as well. Again, lots of familiar faces that I said, and plenty of people. Also, Kirby, great to see you here. Earl, great to see you as well over there on Facebook. But consider sort of the disadvantage, I guess, Rob, that everyday workers are being put. I mean, I look at what the Fed is doing, and I've said this for years, and this is not partisan. I've said this for many, many, many years. The Federal Reserve is very much at risk of, it seems like it wants to do the right thing. It says it's trying to do the right thing, but ultimately it only seems to be helping those with assets, right? So that's where that sort of capital labor equation starts to deteriorate. I talk about the middle class getting squeezed in an hourglass economy where you get handouts for those on the bottom and you got all kinds of upside for those on the top. And then the middle class gets squeezed. But the reason you get that upside on the top is because of what we're looking at. I mean, it's so inverted. You get news that, hey, you lost a lot more jobs than you thought you lost. And guess what? This means you're going to get interest rate cuts, which is beneficiary in a much stronger, bigger way to those with money in markets, which is why I will just, listen, I'm not going to get on my soapbox too much tonight. People hear that enough on my show, but 76research.com, code word dollar, you guys, DOLLAR. You can remember US dollar, right? Dollar. Go sign up for the 76 report because it's just $1 a month for a couple of months and it goes to $9.95. But you can try it out. You can cancel anytime. No cost. We'll refund your dollar, okay, if you hate it that much. But this is what you need to get started because you got to invest. Otherwise, it's the Fed helping out the same darn people all the same darn time. And what I'm trying to do, and you're trying to do, and this is part of our methodology behind 76 Research, is bring more access to capital markets for everyone, right? So that everybody is getting somehow a cut of the action. But the Federal Reserve is not the middle class's friend, if you ask me.
Yep, I think it's the friend to the stock market. It certainly has been the friend to the stock market over the last 20 or 30 years. And the stock market overall has compounded at levels that were above what people would normally consider the cost of equity or the expected return on equities. The stock market has outperformed, and we've gone from one sort of Fed-driven bubble to the next. And every time there's a wobble or weakness in the economy, I mean, the Fed's right there. So I think you want to be on the side of, they say don't fight the Fed. I mean, I can interpret that in a longer term context of be on the side of asset ownership, because that's ultimately, the class of people who are sort of in charge and running the Fed and appointing Fed governors, right? They're all asset owners, with possible exceptions now, I guess, with some of the new politicians on the scene. But no, in general, it's a system that's really kind of relies on growth in nominal asset values, and that favors investors.
Yeah, I'm just looking at some of the comments that are coming in. Don writing, it's been 15 years of free money. Yeah, I don't know what happens when that ends, for goodness sakes. Peace of Mind asking an AI question. And you know what? We're going to get to that momentarily because I know AI is on everybody's mind. Nvidia, of course, being the stock of the moment. And Rob and I have some ideas on how to best play, if you would, the whole tech AI momentum, which is extraordinary. And I do so fundamentally believe in, and I know you do too. So we'll talk about that coming up. But, Mike making the point that if all else fails, you can certainly work hard to save your money. Like, I get it. But what do you do in light of all of this QE, as Don points out? In other words, QE is happening, right? And that's just the way of the world. It's the way of the sort of monetary system that we live with right now. And in light of that, it's sort of like, okay, you don't want to be the one fighting the Fed to the points that you just made. With all of this in mind, let me ask you a question, because we're watching polls. This is like the alternative. If you don't want to watch the DNC, you can be watching Trish and Rob right now, trying to make money, right? In light of all this, again, the DNC is going on, and we're going to hear from Kamala Harris tonight. Polls suggesting that she has a fighting chance. We'll see. I think time will tell. I guess my question is, how much does it matter in the near term who wins the election for the markets? I mean, Kamala Harris, 28% corporate tax. To me, that's a negative for earnings. To me, that's a negative for retirements. $25,000 that she wants to give and housing stipend, a loan, whatever you want to call it, to first-time home buyers. This forgiveness of student debt. I mean, she's got some really, I'm going to be diplomatic here and say interesting policy ideas. To me, they're very inflationary. They're very, in fact, dangerous for U.S. capital markets. But I don't know if she gets any through. I mean, you'd have to have the House and the Senate to get any of this stuff, including this crazy, idea that she's somehow going to tax unrealized capital gains.
Yeah, I mean, it's just such a laundry list. I don't think you even mentioned the price gauging, as she put it, right? The wage and price control, such goofy, disproven ideas. And it's shocking to some extent.
And by the way, let me just add one thing to that, because they are goofy, unproven ideas. And by the way, not just unproven, I'd say they're proven. They've failed every single time somebody has tried this, including, as we discussed recently, Rob, 1971 with Nixon, and none other than Dick Cheney and Rumsfeld, hard at work at trying to control inflation through price controls. It didn't work. It didn't work when FDR tried it. It didn't work when the USSR tried it. It didn't work when Venezuela tried it. She's being very careful, though. She's trying to say, well, I'm going to go after monopolies and this, that, and the other. Well, duh. I mean, of course you can't have monopolies. Nobody's suggesting that there's a monopoly going on. What she's suggesting is something far more sinister, which is price gouging. I'll use the correct term without the word salad. Thank you very much. And in that case, if you're going to actually control prices because you fundamentally believe, and you and I have done the research, they're actually not making a ton of margin on this stuff. They've had to see suppressed margins in light of the inflation, and you can't pass it all on to customers and consumers. They're going to get out of the business. And guess what that's going to do? Hello, thank you very much. It's going to raise prices even more.
Yeah, I mean, the food retail sector, it's intensely competitive. Margins are low. So it's, you're looking, if really they want to turn their sights on potential monopolies or antitrust abuses, look at the tech sector, right? And they are, and I'm not encouraging them to, but it's like, that's where you have high margins and that's where you have very high market shares and all kinds of interesting practices. But, don't go after the grocery store and act, but I really think a lot of it's just theater because they must know, that it really isn't the source of the problem, that the source of the problem is generalized inflation and too much money chasing too few goods.
It's pretty simple. But I guess you never took that class. Mike is joking around. He's like, ooh, all this stock market jargon. What do I do? Listen, I'll tell you what you do. You go to 76 Research, Mike, sign up. If nothing else, just get the free stuff. Okay. Get the free stuff because, there's valuable information there for you. And I created this for a reason. And it's because I so fundamentally believe that more people need to be participating in financial markets. So again, it's 76research.com. Get the free stuff or sign up for the real stuff for $1. If you actually want the inflation protection portfolio, if you want the American resilience portfolio, or if you want the basic income builder portfolio, I really encourage you to do that as well. It's like an additional $23 on top of the $1. Take a look at that stuff, guys, because there's real information in there that I think can be really, really helpful for you. So we got the markets reacting to this election somewhat. We heard from Peace of Mind earlier, who's sort of saying, hey, isn't inflation happening sort of no matter what? How do you think about different sectors? And I think you have to be careful on this because different sectors would respond differently and not necessarily the way you think, right? You and I have talked about this, like the energy market actually did really well, believe it or not, under this administration, Biden-Harris, and this is despite all the nonsense from the likes of Jennifer Granholm, our energy secretary, former governor of Michigan and former MSNBC host, who's now the energy secretary, who doesn't really seem to understand energy markets. But in fact, the flip side of that is she's helped drive energy prices higher, right? By shutting off the spigot here and thereby contributed to greater margin growth within some of these energy companies. So it's fascinating in that, you think, okay, Donald Trump is going to be good for energy markets. And fundamentally, I strongly believe that. And I think it's the right thing from a national security standpoint, from an economic standpoint. But simultaneously, profit margins could actually decline if you have more energy on the market.
Yep. So we kind of wrestled with this issue in a 76 report a few weeks ago on the specific topic of energy markets and the election. And, it's sort of, there's a debate because on the, Trump's point is to bring oil prices down through more domestic production, through, I think, diplomacy with OPEC and international players. His point is to, permit more drilling in general, right? It's a pretty simple platform drill, baby drill. So he wants energy prices low because he views it as, and justifiably, he views it as really kind of a key source of inflation. Biden-Harris administration, on the other hand, they want the green transition. And, to do that, you generally want higher fossil fuel prices. So they got higher fossil fuel prices actually over the course of their administration. And it was a key reason why some of those energy stocks did quite well. I mean, the Ukraine situation was also a major variable there in the recovery from the COVID depths. I think, net, I think if I'm an energy investor and we have a number of different energy related investments across the model portfolios, I think a Trump victory would be a more favorable outcome because it gives you more runway for these various kind of fossil fuel infrastructure plays and and sort of domestic producers, gives you more runway and sort of like a longer lifespan, even if oil prices might be lower for various reasons under a Trump administration.
Yeah. No,
Natural gas.
I think, yeah, go ahead.
No, I was just going to make a quick point on natural gas, which is, one big area policy difference between the two candidates is Trump's very interested in exporting natural gas and via LNG and setting up pipelines and setting up terminals that would actually potentially be boost domestic natural gas prices somewhat, because now our own supplies would be kind of brought more aggressively into international markets. So it's a lot of like puts and takes. I think net, for a variety of reasons, energy investors should be rooting for a Trump victory.
Mm-hmm. Just long-term investment, I think, too, is kind of important. It's just amazing that the energy sector has held up as well as it has. And I think that's sort of in spite of some of the people controlling things. Speaking of which, you look at, because again, I do fundamentally believe like markets kind of rule, right? And that's what sometimes some people forget. We were talking about Jennifer Granholm, everybody's favorite, right? Don has some rather unfortunate things to say about her. But anyway, Jennifer Granholm had insisted back in 2022 that everybody could just save money if they would just go out there and they would buy an EV. Like that would just fix everything somehow. Well, it turns out that didn't fix anything. Nobody went and bought the EVs, despite their sort of pressure to do so from the White House. And Ford just announced this week, it's totally canceling its Cybertruck, the EV Cybertruck that was supposed to be so exciting, right? Like it's no longer happening. They're going to invest in these hybrid vehicles, something that, by the way, Toyota also said. I mean, what's your commentary on that? I guess you can sort of force feed them, but at some point when push comes to shove, these companies are like, wait a second, I need to make money. And I can't make money right now on the whole EV thing. So I'm going to pivot.
Yeah, at the end of the day, I mean, look, the government can say we want, 50% penetration of EVs by this date or whatever their thresholds are, but there's the reality of the marketplace and the consumers need to buy these vehicles and the vehicles need to be produced. And, speaking of Toyota, I read, within the past few months, the chairman of Toyota, which is really a world-class car manufacturer, by the way, and just makes a great product. I own two. They and bought one recently.
Shout
actually,
out for Toyota.
Yeah. But he doesn't believe that EVs will exceed 30% of the market, even, in any kind of reasonable time frame. I think the hybrid approach, just as a practical person, I mean, it does make a lot of sense, right? You get the best of both worlds and that acceleration off the electric motor and, the utility of being on electric power locally. So that makes a lot of sense. I think, look, at the end of the day, the government could wish for all these things and talk about all these things, but it's the car manufacturers and the consumers are the ones who are going to decide, where the equilibrium kind of settles. So I'd be,
you'd be reluctant to go all in on.
Yeah, I mean, look,
Hertz found it out, right? The hard way. I mean, Ford taking a $8 or $1.9 billion charge on this thing. Hertz also having to take a big charge. They had hired Tom Brady to go out and promote these things. And suddenly they realized, gosh, consumers, when they arrive in a new place, don't really love the idea of renting an EV because they don't know if they can charge the darn thing. Thank you very much. And it was like the cart was before the horse. I mean, you have to have the infrastructure built out in order for people to feel secure so that they know where they can get to a charging station. It's not like you're going to land in Timbuktu and say, oh, yeah, give me my EV. No, thank you.
Yeah, and in speaking of the infrastructure, we've talked a lot about maybe transitioning a little bit to AI, my favorite topic of these data centers. The economy is going to require a lot of electricity generation, and it could come from EVs, but it's really on the margin right now. It's coming from all these data centers and the massive power requirements to supply all of these Nvidia chips, right, and these AI servers and machines. So that's yet another strain on the electric grid, and
but there's opportunity. I mean, that's the other, and let's leave EV aside for a second. I mean, you mentioned something I think we're both really passionate about, and that's the future, and the future with AI in there, and not just AI, but sort of the metaverse. It's called the metaverse. I realize Facebook borrowed that term to rename their company, but it's incredible what's happening. And I think it's happening really fast. I mean, I see all kinds of massive changes in technology. The fact that I'm able to do this here with you, who's in another location, in another place, I'm able to do this, you're able to do this, and we're able to go live. Back in the old days, right, working as a correspondent for a news network, they'd have to hire a live truck and send the live truck to your house and to my studio and this, that, and the other. And it would be extremely expensive, extremely difficult, require a lot of people. And now all of a sudden you just press a button and you're here and you can do this and we can go live, we can talk with viewers. And that's just like the first iteration of it. I mean, I look at it from a media perspective and I'm blown away at all the changes that are happening in the here and now and what's coming. And then I look at it from just sort of a investing perspective. And to me, I realize that tech is way up there and people, is this year 2000? In year 2000, I'm going to tell you something. I don't think I've ever told you this, Rob, and I haven't mentioned this to viewers. I was terrified. We had a really good friend who was like a hotshot lawyer at a big white shoe law firm, this and that, and he left it all to go run an online sneaker company. And I'm like, so what? You're like sneakers.com or whatever. Like, what is that? All of a sudden, the .com was everything, but nobody understood sort of the fundamental businesses behind it. And I didn't get it. And I was really pessimistic. At the time, I remember I was a young reporter at Bloomberg Television when I first started, and I would do story after story on the tech meltdown that was coming, and people were like, yeah, it's not here yet. Well, sure enough, it was there. It hit. We moved to San Francisco right in time, I'll tell you. The .com bubble burst, and all of a sudden, those rents that were a fortune came down 65% overnight. You couldn't get a U-Haul truck in all of San Francisco. It was one of the stories I did for the local news. 3-month wait. Okay, so it burst and it burst big. But that one I got because fundamentally there was nothing really backing it up. And now I look at what's going on. I've told you, I went in to try on the goggles at Apple recently. Apple Vision Pro. Regardless of what you think of Apple, and I'm optimistic on Apple over the long run, I think that the sort of opportunity in this space and all the different things it's going to affect is massive. I think you're excited too.
I am. I don't show it as much, but I am.
Yeah, I can't. I wear my heart on my sleeve. It's my downfall. It's also my upside.
But Trish, I think there's a little bit when you think about the opportunity, what we call AI. What it really is, it's more like accelerated computing. It's this idea that you have these supercomputers in these data centers with these, advanced GPUs processing a ton of information very quickly. So I think when you kind of hear it, when the average person kind of hears AI, they think, Chat GPT, your kid's kind of cheating on his test, and or like some sort of customer service interaction. And that's a big part of it. But it really is just, unleashing the power of computing technology on a scale, and it could just go in all kinds of different directions. So, to me, it's just very open-ended, and a big distinction between what we, the late 90s and what we're seeing today is that this is really being funded by the juggernauts of our economy. These Mag 7, the big Facebook, Metas and Googles and Amazons. They're the ones deploying the hundreds of billions of dollars. It's not the retail investor kind of getting bamboozled by pets.com.
It's smart money. It really is. It's an excellent point. I realize the retail investor is a little bit there for the ride, as they should be. A Piece of Mind makes a very good point. He writes, Amazon used to sell only books. I think that's a really important thing to think about. you and I have talked about this,
Yep.
and we've written about this, because you need to think about the opportunities that are coming, right? Like these companies that have a lot of capital that they can put to work have many different manifestations of where they can go. I mean, it's incredible. Really, it is incredible. And, we have to continue this show tomorrow or over the weekend. I just think that there's so much more to be said on this, because there's stuff that we're not even thinking about, even within the medical sphere. I was talking recently when I went into Apple, because I've been back 3 times to see this thing. My son's going to drag every family member. When the grandparents come to town, we're going to have to go see it again. So I've been in there a few times now. And the last guy I was talking to at Apple, who was showing us this, was talking about the implications for the medical field, because he had a medical background, and to think, how you could operate in this, and it's virtual, but you can actually be right there. It's amazing. I mean, I think of it in terms of media, right? And my husband, who's a former basketball player, thinks of it when they showed him the basketball court, and he's like, wow, it's like the closest to ever being on the court I've ever felt. I mean, I guess we all take away different things, but the reality is it's limitless.
When I saw the comment from Peace of My Mind, and the idea of, the concept we talked about 25 years ago when I was in business school was optionality. And we were talking about, and we were doing Amazon case studies. And the idea was, well, they sell books now, but soon they can sell DVDs. And, it's sort of like this, it's a platform for all these new business lines. But what's actually happened is, not only do they sell everything, they're not even a retailer anymore. They're really like a cloud company, right? And so these are really platform companies with all kinds of optionality and all kinds of ways to innovate and to take advantage of new technologies. So that's sort of a characteristic when we kind of think about, where do we want to make these long-term kind of growth-oriented investments? We look for companies that we view as having a lot of optionality and having, the ability to generate revenue in the future that investors today aren't even aware of.
Right. Or even thinking about. And that's why, Nvidia is not actually in our resilience portfolio, in part because we love Nvidia, right? But we recognize the volatility and the vulnerability associated with something like Nvidia. Plus, you can get it in the S&P 500. And, that if you're just starting to invest, one, make sure you go to 76 Research, sign up for the free stuff, get the $1 a month 76 report. But you also want to do those basics, like maybe an S&P 500 index fund that trades under the, SPIDER is what they call it, right? The ticker symbol. Just look up spiders or diamonds for the Dow Jones Industrial Average, or triple Qs there on the NASDAQ. These are sort of simple, easy ways to get involved and have that exposure. And you're going to get that broad exposure, which increasingly it feels less broad because of the Mag 7. But that's one way to do it. The more specialized way was 76 Research. And thankfully, we've been just killing it and doing super well. So I'm so proud of that. We got to throw up the numbers perhaps in the next show so people can see that. But some of our picks have just exploded. And I'm proud of that. But it's in part because I think we've been very practical. So it's looking at in that diversification or optionality, if you would, within some of these names.
Yep. Yeah. No, as you point out, I mean, Nvidia is 6% of the S&P 500, and the other Mag 7s are, 3 to 6%. So you'll have exposure with that index approach, which I do recommend as well. You'll have that exposure. But then I think what we're really trying to do with the model portfolios is, kind of generate some more differentiated ideas to kind of complement that broader index exposure that most people tend to have.
Yeah, I think it's important. I want to resume this conversation tomorrow or over the weekend with you. So I encourage everybody to subscribe to 76 Research, subscribe, of course, to the Trish Regan Show. And most importantly, I should say, subscribe to the actual financial research that we hope is really going to put you on the right path going forward. It's just so critical, and I can't say that enough. And the viewers tease me a little bit because I can turn into Susie Orman really fast, which is not anybody's picnic. But look, you know what? If you don't do this for yourself, nobody else will. So start taking charge of your finances and listen, embrace what this is, because regardless of who's winning, and I certainly have my views on who I think. I just fundamentally believe in a conservative viewpoint on the economy being better for markets overall and for the country. But regardless of that, there is opportunity everywhere and you need to take advantage of that. So code word dollar, DOLLAR. You guys go and sign up 76research.com or go to 76 Report. Use the code word dollar and let's continue our conversation. Rob, always a pleasure.
Yeah, great to see you.
Okay, talk soon.
Take care. Have a good one.